Good afternoon, everybody. Welcome to the first quarter of 2024, our global markets and economic update. My name is Chris Rawson. This is my colleague, Brian Bly. We are going to walk you through a series of data points and provide you the overall update. So let me go into the next slide. We've added a mantra for this presentation, and this is our mantra and for our service is to guide our clients to feel confident in their long-term financial plan and to resist the short-term reaction, temptation, and sensation of our current outrage culture due to deliberate misinformation from our news media. So there are particular bits of information and data and things that we get on our day-to-day, week-to-week, month-to-month that from our perspective is not necessarily accurate, or the point they're trying to make is not relevant to the overall picture. And so while if we get, so myopic on it, we can say, oh my goodness, this is a real issue. If we look on the broader scale, we'll find that it's not as much of an issue. But the way that our current culture is working is to get that attention and get that reaction. So part of our focus in this area is to give you what you should be seeing and how you should be thinking about things. So with that in mind, let's jump in. This is our agenda. We have agenda for any single meeting we ever have as we serve clients and even internally within vision-based planning. So this is the format. We're going to start with the United States, walk you through the good and bad, international developed, as well as international emerging markets. Then we'll talk about fixed income, which in another term for that is called bonds, the more conservative part of anyone's portfolio that they can own. We'll comment on how we are applying the data that we're going to review with you to those models, to the models that we manage on behalf of our clients and families, and then we'll end with Q&A. Having said that, any questions that you have, please put them into the Q&A section in the webinar here. We're going to use the chat in a little bit because there'll be some questions. So please feel free to jump in and reply and give us your thoughts when we get to that section. And then lastly, there's a survey. Should take you less than 30 seconds, but please give us feedback. We always take that into account, and we've actually applied some things today, and so hopefully you'll notice the difference. Okay, Brian, having said that, let me turn it over to you.
All right, good. Thanks, Chris. So first we'll cover United States, the good. So our first point of focus here is taking a look at the blue line, which represents the wage growth over the last 40 years. But taking a look at where we ended up at year end, we were at 4.3% wage growth year over year. So it's getting back closer to the historic norm of about 3.9. So it's moderating a bit, but still it's a good pace. And then also another side note on that is, for those retirees that are going to be taking or are currently taking Social Security, one point of note that the Social Security cost of living adjustment for this going into 2024 was 3.2%. So the reason I mentioned both of those, the wage growth as well as the Social Security cost of living index, is represented on the next slide. So as you see, it's good thing. Now our growth, whether you're a retiree or a worker in general, is exceeding the current inflation rate within the U.S. So last quarter, I think we looked at this, our inflation rate in the U.S. was 3.7, and now it's down to 3.1. So basically, our wage increases, Social Security increases is now outpacing inflation as we move along. And this is a snippet from the Schwab quarterly chart book, just representing that we still have more openings than we have people looking for work. So the number of job openings is represented by the line in blue. So since you know, early 2021, or I guess really going into to early 2022, late 2021, our job openings have exceeded the number of people looking for work. So right now, as we currently stand, we've got about 8.7 million job openings. And the people looking for work is 6.3%. I mean, 6.3 million. And meanwhile, our unemployment rate remains good and holding steady as far as current and historic terms are concerned.
Good. Next, I'm going to cover some of the bad points about where we are um, currently within the US. And so this first piece is here, which is delinquencies within people's cash flows. So what you see here in terms of auto payments, credit card payments, student loans remaining flat, that will start to rise as those expectations get in place that student loans will need to begin to be repaid. But what you see is this trend here that these delinquencies are rising. And if all I showed you was this one part of the chart, it may be very concerning. When you look at the broader scale, which is the overall household debt service, which includes the mortgage as well, you see the numbers at 9.9. So that's well within the average all the way back to the 1980s. So it is a concern. It is something that's, day to day Americans are dealing with. And these are bullet points that we'll hear from our news media. But in the larger scale, it went from a low point from the last 20 years to a more average place within these three areas. But from the household overall, this is not a big it's within historic numbers. So it's a concern. We're looking at it, we're aware of it, but there is a broader picture to see as well. Okay, the next piece is the fact that we have our government. It's not only government spending. So on the top left, you see here the 2023 federal budget for our government was 6.1 trillion dollars. That's our total spending. On the right here is our sources of financing, so taxes. We have federal income tax from individuals, corporate income tax. This is Social Security and Medicare tax, and this other is tariffs that we levy on foreign governments to import their goods. And so what's left is what we borrow and what we finance by selling our government bonds. So we are financing $1.7 trillion to fund our budget. So there are two things that we can do here. One, we can reduce spending, and two, we can increase taxes. And so spending has come down. Brian and I look at these numbers every quarter. So we did see spending decline since last quarter. And so increasing taxes is not on the horizon. The previous administration lowered taxes. Matter of fact, tax planning is a key focal point that we're focusing on in the next 2 years as we are serving our clients. But it is a point of note. So this is something we're bringing to the fore and saying, okay, we're financing $1.7 trillion, and that's not good. It's that's a meaningful amount. Okay, let me go to the next piece. This is an election year. I want to highlight a couple of things that is important to note here. There are, and not the majority, but a subset of people over these previous administrations, Obama, for example, when he was president, there was a subset of people who would not invest in their accounts because of the fact that he was in office. And then there were a subset of people who didn't invest under Trump because he was in office. And then the same thing with Biden, wouldn't invest because Biden's in office. This on the left-hand side is the annualized stock market performance over the history of the tenure of their presidency. And the average is just over 15%. It's 16%. So the number is exactly the same. You see them, the average annualized return is 16%. So imagine missing out on that growth. And then this next piece, which is more towards our current, is from time to time, not a lot, but time to time, I'll hear people say that they're feeling sour about their investment accounts because of who the president is, and that things were so much better under the previous administration. This is the S&P 500 from the beginning of each of their election to where we are now. And there isn't that much of a difference. So I'm trying, and going back to how we started the presentation, is highlighting these data points so that we can fight any type of narrative that we're getting to get us to, react to some data points. So as we think about going into the fall and into next year, it's important for you to know or to not allow any of your political preferences or whoever you want in office to affect your investment and financial planning decisions, because from a risk management and long-term return perspective, it does not make your financial plan will not be derailed by whoever gets elected in this election. Okay, I'm going to leave it at that point. And Brian, now let me turn this over to you.
Yeah, so just to wrap up the United States section, as mentioned before, growth in both wages and Social Security has now gone beyond the inflation. So therefore, that will be a positive effect in people's pockets going forward. As mentioned before, we've got more job openings than people, and our unemployment rate remains low. It's currently at 3.7%. And on the contrary, just like Chris mentioned, some things, they're bad, but not necessarily bad, but just things we're keeping watch on because of the increase with the while remaining overall debt servicing remains on par with recent historicals. Credit card and all loan default rates, and maybe college here in the next year or so have increased a little bit. And then, as Chris mentioned, our deficit spending has added to our debt balance going into 2024. So switching over from the U.S. To abroad, to international developed markets. Similar to the US, wage growth has picked up. And in the Eurozone, the wage growth as of the end of the fourth quarter, numbers hadn't come in yet, third quarter was 4.7%. And while that's important, is a very similar story to the US. As far as inflation rates concerned in the Eurozone, the inflation rate is now at 2.4% across the Eurozone. And when we looked at it last quarter, during this review, the inflation rate was actually for the Eurozone was 5.2%. So their inflation rate has come down considerably, but just as important as in the US, the wage growth is now above the inflation, which hopefully will, while inflation picked up over the past years from COVID, hopefully folks are going to be feeling and seeing a less of an impact on their pocketbooks and wallets now that the income growth are now being above the inflation rates in both the U.S. and the international abroad market. And this is just like a comparison. Once again, valuations for U.S. equities as well as dividend yields, um, relative to the US are very favorable. So, you know, that's why we have an international component within our investment portfolios for y'all. And that's why we'll continue to do that, is because we want to make remain diversified, take advantage of any dislocations. And as we can see here, the valuations, both from a relative perspective to the US and dividends are favorable for the developed markets.
This is where I'm going to jump in here. So the biggest piece within international is some of the lately this quarter is the Houthi rebels right in this area here in Yemen, attacking the shipping lanes, and essentially there's fewer boats and shipping going through the Suez Canal. And so what these companies are doing is going around Africa and up here. And so what that is doing is delaying the shipping times. So let me zoom out slightly. So you see global shipping um, supply chain. This is in the fall right here. So you see an immediate rise in slower delivery times because the shipping lanes are going around Africa rather than going up and through the Suez Canal. Um, that's it. It's not going to, here again, it's not going to totally derail performance in terms of the investment accounts or even your personal financial plan, but it's a disruption. It's not good. And that's something that we're looking at and making you aware of. Okay. And so checking my notes here, just wrap up the summary. What's good is wage growth is higher than inflation in the Eurozone, just like in the US. So wage growth at 4.7, inflation at 2.4, which means the consumer is getting ahead, which is definitely a good thing. International valuation remains attractive, and dividend yields are very healthy in Europe compared to the US. And bad is exactly what I just described. Shipping lanes going around the Red Sea due to conflict in that area.
So we'll transition now over to emerging markets on the international front. So just a couple quick points in here. So um, for emerging markets, India, this is a reflection of the previous years, 2013, 10 years, the 2022 average, the forecast or close to actuals for 23, and then the forecast 5 years out in 2028. So we noted this last time, but India remains very strong as part of the emerging markets group. Now, while China has fallen off a little bit over the years, projected to fall off a little bit more, but they still have a positive year over year GDP growth. And as you can see there, the next bucket down, the rest of the emerging markets buckets, whether it's Brazil or Taiwan or Korea or other Latin America, Southeast Asia countries, relative to the US and other developed markets, the GDP growth is forecast to has been and is forecasted to be stronger than the developed markets over the next year to 5 years. So for many of the portfolios we still have, this is the reason why we still have a percentage, while not a high percentage, we still have a percentage allocated to international emerging markets just to take advantage of these opportunities. From a bad standpoint, this kind of goes along the same tone as we did for developed markets. Iran is supporting terrorism globally, financing the Houthis, the Hezbollah, Hamas, and others. And then, even though doesn't get the highlight on the media as much as it used to. The Russia-Ukraine conflict war is heading into year three now, um, going into this quarter.
Okay, now we're going to shift to the more conservative portion of your portfolio, which is a fixed income or the bonds. So this is where we're going to begin to use the chat. In the blue is our Federal Reserve. And so the question is, when was the last time the Federal Reserve raised interest rates? And so I know I'm putting, those of you who are here on the spot. So if you would go ahead and put it in the chat and just guess, guess a month. You can just put a month in there. Whatever month of last year. So you see how this is flat. When was the last time that the Federal Reserve raised interest rates? And I'll just take, 5 seconds or so to maybe get a couple of replies uh, from folks. That may be a cue. Okay, for time purposes and for the replay, I'll just go ahead and tell each of you. It's July. July of 2023 was the last time that interest rates rose. Said another way, interest rates have not risen in more than 6 months. And so there's this ongoing conversation about when are they going to come down? When are they going to come down? Well, that's not a huge, I don't have that much energy around that. Interest rates will come down, whether they come down in February or March, or whether they come down in June or July, it'll just be part of that process. So what's important to know is that interest rates have essentially stopped rising, and for good reason. So they'll remain where they are and not decline for good reason until the time is right. So we've experienced rising interest rates over the last 2 years. And when you see these bar charts in gray, you see a lot of negative numbers. And so if you imagine a seesaw in your mind, and Brian's going to walk us through this later, and you have interest rates on one side, and I'll put interest rates on this side and bond values on the other, or I'll do it this, I'm sorry. When interest rates rise, bond values fall, which is why we bought a lot of CDs for our clients throughout these rising rate environment, because we knew there were going to be negative returns in this area. Well, when we look over the next 2 years, interest rates are going to be going down, which means there will be price appreciation within our more conservative investments. So the blue side of this chart is what we're going to be seeing over the next 2 years. So this is a good thing. And that's why I'm not in a big rush for interest rates to go down, whether it be in the next couple of months or 3 months or 5 months. Over the next 2 years, interest rates will be going down. And this is very much part of our thought process and focus as we think about where things are. Okay, and then the bad part about high interest rates is, what does it cost our government to finance the bonds that we're selling? So that's the net interest. The cost to us to pay the mortgage is just under $660 billion in interest payments. That represents 11% of the federal budget. So higher interest rates increases our cost to borrow, our net interest. So that's not a good thing, and something that we are aware of. So to sum up, July of 2023 was the last increase by the Federal Reserve. Bond values rise when interest rates fall. That's very important for you to know, and there'll be a couple other points on that as we continue the presentation. And higher interest rates has increased the cost for our government to finance our annual budget, and that's not good. Okay, Brian, let me turn this part over to you.
Uh, So now with all this data in mind, this is how we are applying it, this information, this new information on your all's behalf. So Chris already got into this a little bit, but this is our seesaw analogy. So first off, to explain duration, duration is really the measure of the bond, the fixed income assets price sensitivity to a change in interest rates. So as Chris already explained, what we experienced over the last 2 years, rates have risen, which resulted in a decrease in the asset underlying fixed income asset value. And the longer the duration of the asset value, 3-year bond, 5-year bond, 10-year bond, um, the larger the duration, the greater the extent of the increase. And as Chris touched upon before, that's the reason why when over the last 2 years, when rates rose, we transitioned to 3 and 6 month CDs. We basically cut the duration down. We were able to clip the coupon rate, the 4.5, the 5% interest that the CD was paying, but yet we were able to mitigate the issue of the potential falling price or value of the underlying asset. So that was one reason we transitioned all the fixed income portion from bonds to the CD, a short-term 3-month, 6-month CD, in order to stabilize and de-risk the piece of it, the asset declining from a price perspective. Now, moving forward, we anticipate that the rates will be rising over the next declining over the next 2 years.
Yeah.
So what we're doing had started doing last quarter, and we're going to be doing more this quarter. We're actually increasing the duration of the fixed income components of your portfolio. So that being said, that means as the duration increases and the rates decline over the next 2 years, the underlying asset value or the price will also go up. So you'll be clipping the coupon rate of that particular fixed income asset as well as experiencing price appreciation. So we're trying to maximize the total return of the fixed income portion over moving forward. So that as we progress through 2024, we will be looking to increase that duration in order to maximize the asset appreciation aspect of your fixed income. And just to touch a little bit on this, lots of numbers here, but really the main point is we're also transitioning a small portion of the U.S. equity portfolios from large cap to small and mid cap equities. And the reason why is more, and you can see there on the lower charts, it's more just looking from a relative number perspective. As you can see there, the small and mid cap components of the U.S. equity market are undervalued compared to large. So we're just taking a small portion of the large cap allocation and moving it to mid and small to take advantage of the dislocation, as well as, with the U.S. economy doing well, the consumer doing well, all that feeds into a better economy moving forward. And with interest rates also going down, small and mid-size companies should be able to benefit from that.
Okay, so this is to sum up exactly what, to Brian's point, increasing duration into 2024 as interest rates are in a holding pattern and will be declining over the next 2 years. And Brian just touched on this point. Okay, so this concludes the formal presentation part of our pre-prepared remarks, as it would be.